welcome to Mirror Me, where we feature entrepreneurs in the region. And today we're very honored to have Mr. Thomas Ng from OnlineGuruTrader with us, where he will actually share with us more about the entrepreneur's journey. Okay, so thank you so much, Thomas, for joining us today.
Thank you. I'm excited to be here also.
Yeah. So could you like to share with us how has this trading journey been with you?
Actually I started this trading journey since like almost 24 years ago, when I was at the age of 20. So I was looking at why people could use some of their money to make more money. I was fascinated by it. So I really slowly along the way I built on my passion for trading and investing, and because of that, along the way I would say it's pretty rewarding, and also through a lot of experience through trading and investing, there's ups and downs, and it really helped me to understand that we can really put aside a sum of money, and through a system, a strategy, to really generate more wealth for our family, ourselves, and that is one of the most rewarding things. Why? Because with more wealth through money terms, through trading, we can actually spend more time and resources in the things that we really want to do, right? Like spend time with our kids, and really provide more for our family as well. Yeah.
Right. That's very inspiring, I would say, because at a very young age, Thomas actually started to explore, and go into this trading route. But it has been like 20 over years. What really kept you going? Because trading, I find that it can be very challenging.
Yes,
it is very challenging.
I've seen, because I teach as well. I teach trading as well. So I've seen a lot of people who have come to me after they have stopped like 5-10 years. They are in, and their story with me, all their story was that they started initially for 1-2 years, then they bust their account and things like that, and they decided that trading was not for them, and they stopped for like few years, like sometimes it's 3 or 5 or even 10 years. Then they came back and say, they are more ready, because maybe they were younger then, and they were going for their full-time career, building up their career up. So towards their like mid-age, something like mine, and they come to me and say they are more ready, and I totally understand that it's really challenging, because the way I see it is that the initial phase is very challenging, in the sense that there will be a lot of so-called roadblocks in the sense that they hit with some losses and things like that, and some will be huge losses. Typically that's the case for newcomers into this trading and investing industry. Why? Is because they didn't know that what they didn't know, as in they should have controlled their money in terms of money management, or what in trading terms we call risk management, and because they didn't have that kind of risk management strategy or concept in place when they started, because they didn't know anything. They just thought that I just put my money there and the money will just grow along the way. So I would say it's really challenging for newcomers. Really have a strategy in place, a systematic strategy that along the way it will produce results. Okay, it could be good and bad results, but the thing is, I always thought when I was starting, I didn't have many good results. In fact, I have very bad results. And I told myself, is my results consistent? Because if my results is consistent, it's based on the consistent decision making and strategies that I employ at that point of time that produce the consistent results, even though it's bad results. Okay, so how can I do in terms of tweaking the decision making or the strategies that I'm employing, so that I can change the end results, even though it's consistent? So along the way, I told myself, okay, this decision A shouldn't be there. This criteria this step shouldn't be there. And along the way, I formulated a strategy whereby, okay, if I follow this, I will have this type of kind of positive returns and profitable results. And since then, that was like in 2010 when I formulated my strategy, and I knew that I tested it out, and using that strategy, I was able to be getting consistent profits from then on. Okay, so from 1996 all the way, around 1996 all the way to 2010, I was actually still struggling, to be frank. But since 2010, it has been rewarding for me. Like I say, that is all down to the strategy. Yeah. So initially, people who find it challenging, my advice is that you want to be able to try your best in the very shortest point of time, read up a lot, learn a lot about risk management, money management, the way to analyze the market, whether it's fundamental or technical analysis. You want to formulate steps in your strategy so that it's more systematic. Yeah, so that you will not deviate too much from your decision making. Right. So that your results will be consistent. And only then, when your results is consistent, whether it's a good results or bad result, then you can start to tweak your decision making, your steps, your strategy.
I think that's very good. Thomas has picked up many key points, or rather key secrets, which I think very much is that, firstly, if you fail, we really have to pick up stronger and wiser, right? And it seems like to minimize the failure rate as we progress, we need to have some system, okay? And from the system, we can then look back to see whether, okay, how did we fail out, or how did we, make that loss, and gradually, this become a data for us to fine-tune the strategies. So with that strategy, then the next key is how consistent can that be, to bring us to that means it's like consistency, because the market is dynamic. Would it be challenging to be consistent, or are we able to become, we look back to our journal that we noted down, maybe our successful and our failed trades, but if the market evolves, do we keep having to evolve our strategies to fit the market?
That's a very good question. But the market, though, is very dynamic. You have to formulate a strategy whereby, in a good market and in a bad market, because as traders, we are slightly different from investors. Investors normally want to buy and hold, and put their money there and hope the value goes up or things like that. But for traders, we are looking not just on the buy side, we are looking at the sell side as well. So when market can either go up, down, or sideways. 3 ways it can go, right? So the strategies that we formulate got to be able to, of course, when we buy, if market goes sideways, we don't lose, we don't make. And if we sell, market goes sideways, we don't lose, we don't make as well. So basically, as traders, we are, or even investors, we are just looking at up or down. Because sideways doesn't matter. Right. Sideways doesn't matter. Yes. So in that sense, the market is dynamic, but if we have a strategy, or so-called more into the risk management factor, we don't overtrade, number one. No matter how good our analysis is, because a lot of people out there always think that, oh, this analysis is fantastic, just this particular one. It looks so beautiful, so nice, so good. I think I should put more money in.
Oh, okay.
Because a lot of people come to me, I feel this is really good, I put in a lot of money. This is not so good, maybe I put a little bit lesser. But they don't really have an overall risk management strategy in place, whereby, regardless of whether it's good or good analysis or slightly worse off analysis, I will put almost around the same amount of risk, money. into that trade or investment. Okay, and if we were to have another way to say is, if we were to have a risk management strategy in place, because our strategy can never be 100% right and always winning, and that is why it comes down to our risk management, whereby if we are wrong, we just we limit our losses by cutting our losses. Okay, so I also don't know when my strategy work really well at times and work really bad at times, and it does work bad at times. But when times whereby the market is not in tune with my strategy, I will just limit my losses to small losses.
Right. Okay.
That is the key thing. So if we were to able to think it this way, if we were to say because market goes up and down, and maybe our strategy is like maybe just 40% win rate. 40% win rate, meaning 10 trades, we can only win 4 trades. That's, I think, quite a low expectation. A lot of people will expect more. Okay. So let's go to that situation. So every 10 trades, there's only 4 winning trades. But yet, that guy who is doing this is still profitable. Why? Because he limits his losses to small losses, right? And maximize his profits when he is in a winning trade by getting the big winning trades. I give you a more detailed example here is that let's say we bring this down to just $1. Okay, so 10 trades, each trade we are going to risk $1. That means if we lose, we just lose $1. Right? So 10 trades, we lose $1. If we lose, and we lose 6 trades because we only have 4 winning trades, right? So we will lose $6. But the 4 winning trades, each trade, we make sure we make at least $2 of profit. So 4 winning trades will generate us $8 of profit. Right? $8, if you minus off the $6 of loss, right, we still have a profit of $2. Of course, I'm using the lowest denominator here. It could be $100 per trade, it could be $1,000 a trade, because if it's a risk of $1,000 per trade, we are looking at $2,000 of profit in 10 trades. Okay, if it's like $10,000 per trade, then it is easily $20,000 of profit in just 10 trades. So this is very powerful. I hope the people out there can really employ this type of concept into your risk management and try to formulate it so that your risk management strategy will have this concept in place, limiting your losses to small amount so that when the winnings come, you can maximize your profits and make the big winning trades.
I think what Thomas pointed out very much is the probability part, where again it goes back to perhaps the risk reward, like how much we're willing to risk for that percentage of that gain, and the probability, even though may not favor the win part, but the quantum of the win can be bigger to cover the losses. But that have to have some kind of calculations or strategies built into that. So what is your advice for traders out there that they can improve their risk reward ratio? May not be just focusing on the win aspect, win or loss rate for that probability period, but for like given time frame or how many trades, what is your suggestion that they can look into to improve their risk reward? That's the thing, because sometimes it's that before they reach that targeted profit, they could be too eager to close the position, or they doesn't want to cut loss. They leave it to compound and end up the drawdown becomes high such that they landed in busting accounts. This is a very typical, like a little bit more like emotions and psychology part than even strategies.
Very good question. The way I see it is still down to they are not following their strategy. Provided they have that strategy in the first place, right? Yes. So if you have formulated a strategy, the first thing is, why did you formulate the strategy if you are not going to follow it in the first place, right? In the first place. That's what I learned during my earlier years. I formulate strategy and end up I was not following it, all because of my psychology, my mind, my emotions affecting my psychology. So that is one part. But if you were to just think of the concept that I mentioned earlier and really apply it in the sense that it may not be 10 trades because the market is dynamic, like what Zelda said. So, but if we were to ensure that such a concept in our risk management strategy is employed, in the long run we can be profitable, right? Makes no sense because only 40% win rate and market is dynamic, so that we are the 40% example is already quite a bad scenario, right? So I would say cultivate the belief, the conviction in your risk management strategy so that you can follow through. Because once you follow through, you will notice that you will not overtrade, you will not say you will not cut loss, and you will not say you will not take the profits when the profits are there and you know that it's a good profit. Because greed and fear is very dominant in everyone, especially in the markets. And because when we buy and sell, it's all not because of logic. Okay, by now everyone should know that we buy and sell not because of logic. We buy and sell because of emotions, right? And we use the logic to justify our emotions, right? So the market itself is a mass collection of fear and greed fighting each other, right? So if we were to say we have this strategy and it's pretty good, and if we were to put our emotions, our psychology aside, and we just stick to it, we will not do so bad. In fact, we will do pretty well compared with those who have, number one, okay, you've got to think, a lot of people out there do not have a strategy in the first place. A lot of people do not have a risk management concept and strategy in place to employ, to apply into the markets. So if you were to have that, you will fare so much better than the rest of the people out there, right? So, yeah, that's it. Yeah.
Okay, I read that what Thomas mentioned. Very much to sum it up, is also like the real winner is very much of how they can manage their psychology and emotion versus the market that majority of them will probably lost because of their psychology part. And to combat that very much would be like they have to be really disciplined with the system they have already developed, or the strategies that they have already formulated, and really be disciplined to follow through, to minimize the emotion part of like coming to think, okay, which actually could deviate from the trading plan itself, right? That is like how does trading
the key thing I think will be to say is that you got to have the belief to the point of conviction in your strategy, in the things that you're doing. Okay,
I see.
Provided you have that strategy, that systematic approach to putting in that trade, to analyzing the market, all the way to your risk management. You have that approach already. You have that systematic approach. You have that strategy in place. But a lot of people have that also.
Correct. Yeah.
Right? A lot of people. So I think I missed out a little bit just now, which is the main point, and I feel is that utmost belief to the point of conviction that your strategy will work over time. And you got to have that belief even though it has not happened yet. It's just like faith. Faith is something that you do not see, you do not touch. You do not see, you do not touch, but some people have that utmost conviction in the things that they believe in, that even if it didn't happen yet, okay, they still press through, and eventually it happened, right?
Yes.
So statistically, you already know the statistic. I already show you the statistic. So you got to believe in it and really apply it, right?
Yes.
So maybe the next question will be to say, no, how do I have that? How do I cultivate my psychology? How do I have that belief system and things like that? I would say I don't know about the rest of people, but I do always meditate through priming myself. Okay, priming myself for success and priming myself. So what a small exercise I do every day is to prime myself, and in the sense that I will get myself ready and really appreciate life. Okay, but I always believe when you appreciate life and everything that is around you, your psychology is so much better. The water that we drink, the things that we have, we are so much better than more than maybe 80 to 90% of the world population. More than 50% of the world population live less. If the last that I know, more than 50% of the world population live less than $1 a day. That is something that we should be grateful for, and every day we should be reminded of ourselves. So I do that through my priming exercise, and it gets me in a really good state of mind. And when you are in a very good state of mind, your psychology is better, your emotions is better, you approach trading so much better as well. Okay, and from there you will be able to cultivate that belief and conviction. Okay, that's what I do. Okay, and I believe a lot of very good traders are very appreciative of life and grateful for life, and they have that innate ability of what I said just now. But I wasn't born with it, so I do priming exercise every day just to cultivate that belief. Yeah.
Wow. I'm really appreciative that Thomas actually shared this very important, I would say, the energy. Yes. Because just very, I don't know, it's a coincidence, but seriously, yesterday I was like, coming upon like how millionaires treat their money. And it's like that this is called Ken Honda, is a Japanese, that he say that arigato your money in, arigato your money out, is to be really appreciative. And he say that it's the people, it is not the money that actually that becomes very important for us to bring us to where we want to be at the end of the day. So it's really to be grateful and be appreciative of whatever you have. And the money flow, even that, whatever money that I was thinking, just like, oh, so it's like if you, as a trader, you would have lost some money, we just still say that, okay, arigato, for the money, it will goes out to bless the rest of the people, and then please come back with more friends. So it comes at, wow, okay, it's like when I was trying to recite that, it brought smile to me. So I thought that this is a very good point that not many traders move towards that.
Subscribe to our YouTube channel and click the bell reminder so you won't miss any special monetization opportunities. Go follow now.